Hi there, everyone. Thank you for your attendance and welcome to another installment of Oreana's Wealth webinars. My name is Andre Mudigdo, one of the senior advisors with Oreana Private Wealth in Hong Kong, and I'll be moderating today's session. Before we get into the content, there are a few housekeeping rules that I want to start off with. The first thing is about audio settings. This is where you can decide which audio speaker you get to listen to. Everyone will be muted during the webinar, please note. So any chats among attendees will be switched off, but you can still message us via the chat if you have any issues with regards to connectivity or anything you'd want to reach out to us about. In terms of reaching out to the panel or to the speakers, Isaac and Suresh, please use the quick Q&A button for questions. And what we'll do is we'll address those questions at the end of the webinar. I know a lot of people will be asking if we are recording this. We are. So this entire webinar will be recorded, and you will be receiving the recording as part of the follow-up email that will go around after the webinar is complete. Okay, then. The topic for today's webinar is sustainable investing, key concepts, trends, and developments. So we'll just start the presentation. We're fortunate to have with us Dr. Isaac Poole, Oreana's Chief Investment Officer, as well as Mr. Suresh Mistry, co-founder of Alquity Investments. And they're here to guide us through this very important topic of sustainable investing, and including things such as how ESG concepts can be infused into investment portfolios and actually play a role in generating long-term returns. So without further ado, I'll hand over to Isaac to go through the presentation.
Great, thanks, Andre, for that intro, and thank you everybody for joining us today. It's really great today that it isn't just me talking. I'm ably joined by Suresh, as Andre said, from Alquity. And Suresh is the co-founder of Alquity. He is truly an expert in all things ESG and sustainability. He has years of experience, and we're really happy and also really proud to be partnering with Alquity within our portfolios and more broadly. So look forward to his part of the presentation shortly. And just to quickly point out, Suresh is joining us from London, so it is 5 o'clock in the morning there. We absolutely appreciate you getting up early to help out. So I'll start off with a brief discussion, and then I'll pass on to Suresh. But I guess, sustainable investing, ESG, it's something that has really gathered a lot of momentum and interest and focus over the past 12 months. Particularly, it's increased a lot during the pandemic. And what I thought I'd do today is share with you all some material that we put out recently in a sustainable investing white paper. Some of you may have received that, but it's available and will be available as part of this. So we've seen sustainable investing interest increase from regulators, from fund managers, from yourselves as investors. And so we decided we'd put out a white paper to discuss the area. And we wanted to share that with you all for a few reasons. And first, amongst one of the first or key reasons for that was sustainable investing is part of our beliefs, part of our belief structure. We have sustainable investing as part of our beliefs. We've been working with our investment partners like Alquity for some time to see how we can improve that in the portfolios. So it was a timely and important part of our own governance to really focus in on that. Secondly, sustainable investing is an increasingly important part of investment governance, and we wanted to share with our investors just how that was relevant for them and how it's part of our role in fulfilling our best interest duty for you. Third, there was demand for it. People were interested in hearing about sustainable investing. We were hearing it from our investors in Hong Kong, from our investors in Asia and Australia. They wanted to know more about this. So we went out and put something together to show that we have started that journey towards fully embracing sustainability, and that we wanted to go on that journey with our investors. So that those three reasons sort of show part of why we started this, but yeah, that sort of brings the question of, was there a need for us to do that? And look, we think it's important. We think there are important steps and things that we can do for embracing sustainable investment. And I'll go through those. I mean, first of all, it is no easy task to change investment processes to integrate sustainable investing. You need to understand sustainability, you need knowledge, you need expertise, you need great partners to work with. And without that, it's really challenging to embrace. Second, I mentioned this in the previous slide, sustainable investing really is linked to best interest and the fiduciary duty we owe to our investors. We think it's important that we understand your values. We think it's important that we know how we can reflect those values in portfolios. And we think it's important to know how those values might shape your investment objectives and your investment mission and what you want to do. We want to understand that. So that's a really important part for us in the in this sustainable journey. Third, we want sustainability, sustainable investing and ESG to be an integrated part of our investment process. That's easier said than it is done, but we have begun that process. We're working closely with our investment partners, with people like Suresh and Alquity, to build something that is robust, to build portfolios that are credibly implementing sustainability and ESG features within the portfolio and driving returns. And that takes us to the fourth part of implementing sustainable investing within a portfolio. It's the practical part of all of this. It's easy to talk about. It's easy to write a white paper. It's easy to read about sustainability and ESG investing, but the rubber really hits the road when you have to build a portfolio and select investments that are going to meet the objectives and the values that we have within sustainability, but also deliver returns. And we've seen that there is a risk and a temptation to sort of jump straight to implementation and try and find the latest theme and fad and topic in ESG and stick it into the portfolio. But we resist doing that. We think it's more important to begin the journey, have a really clear pathway forward, select great partners to work with, and that's going to deliver better outcomes in our view. And those outcomes are potentially meaningful. I mean, there's a big question of why bother with all of this? Is it just to do good? And there are lots of reasons why you might consider implementing sustainable investing. And the chart here on the left-hand side shows a whole lot of reasons that came out of a survey with BNP Paribas. And you can see that there could be belief-driven. It could be due to non-financial investment objectives. It could be a desire to do good. It could be cultural. It could be a personal belief. There could be loads of reasons for implementing sustainable investing. But for us, it's really important that there is a risk and a return outcome there that meets the investment objectives. And after all, we are investing here to make money. So that is a critical part. We need to be able to evidence and see that sustainable investing, ESG investing, can deliver better risk-adjusted returns for our investors. And the reality is there is actually a very clear, strong, growing body of evidence that suggests that it absolutely does. And those excess returns could be very large. On the right-hand side of this slide, you can see that the empirical evidence suggests that the extra returns from implementing sustainable investing could be as high as 2.3% to 4.4% per annum. That is significant. It doesn't guarantee you'll get those returns, but it means that it's absolutely critical that we as investment partners and as your advisors are thinking about it and thinking about how we can implement that. So with that in mind, I'm now going to pass over to Suresh to really give a deeper dive and some very insightful comments around how they think about all of this.
Excellent. Thank you very much for that introduction, Isaac and Andre. Let me just make sure my screen is up and shared with you. It's a pleasure to join you this morning for me in London, and it's happening for yourselves on sustainable investing, and specifically about Alquity's approach and how we achieve some of those things that Isaac mentioned in terms of kind of marrying values with returns and with the kind of goal of kind of sustainability. As Isaac mentioned, I'm one of the co-founders of Alquity and also responsible for our ESG and impact work and reporting. So I'd like to start by just giving you an intro into who Alquity is. Many of you may not have heard of us previously, but what we are is we're a pure ESG only fund manager, ESG and impact. So we founded the business around 10 years ago, and we primarily invest in equities. So that's company stocks in emerging markets and also recently into global equities. For us, ESG and responsibility has been in our DNA, and I'll explain that in a second about how we came about building this business and how sustainable investing is not a trend. It's something that has been around for a long time and is something that we've learned to do over a long period. Also, we have a unique business model, which I will explain, which means that not only do our portfolios invest in companies that are responsible and look after their environment and their communities, but we also commit our own revenues, that's the revenues my firm makes, towards projects where we invest. And I'll explain why we do that in a second. Over the years, as a firm, we've managed to acquire some significant kind of recognition of what we do. The United Nations Principles for Responsible Investment, which is the main body of signatories around the world for responsible investment, have rated our process a AAA+. Very few companies achieve that. We also have a French finance ministry driven label called the label ISR, which we see as the gold standard in responsible investment, and all our funds have achieved that since 2018. And we continue to have that designation for our funds. And we're often winning awards with various magazines and industry groups over the years, and a couple are there to reflect our position. But before I talk about what we do, let me take you back about 10 years or so, just when we were thinking about launching Alquity. And at the time, the world had just come out of the global financial crisis. Oops. My screen doesn't seem to want to be working. Okay, the world was just coming out of the global financial crisis. And when we were looking at the world of business, never mind just the world of investment, we saw three key things or three megatrends as such that were affecting the planet. Firstly, the search for growth. People wanted returns. We've just come out of the global financial crisis. There had been major issues created by that, and countries and economies were really under pressure, and people were looking for places to achieve that return from their investments or their savings. At the same time, companies were began to focus on social responsibility. At the time, it was called CSR, corporate social responsibility, and often it just involved giving money to charity or doing some good things within their communities. But it was becoming a growing trend within the world of business, particularly as we went through the last decade or so. We've seen some major issues, whether it's the Volkswagen scandal around emissions, or whether it's things like the Rana Plaza disaster in Bangladesh, where several thousand people died because of the working conditions within the factory. So we saw corporates realizing that they had to start looking at how they related with the society, not just in terms of finance and profits, but in terms of the contribution they were making. And what was driving that? It was being driven by ethical consumerism. People were shifting the way their lifestyles, and they were shifting the way they were consuming products, whether that was food moving to fair trade or ethical products, or whether it's how they were dressing or how they were traveling, for example. So we saw those three trends, and we realized that within the world of investment, these trends were not even being considered, never mind being addressed. So we felt it was an opportunity to create something which kind of answered these issues in a way that was actually great for investors. So at the time, we created the Alquity, what we would call the Alquity Virtuous Circle. And this is where we look at ESG and sustainable investing in a holistic manner, rather than looking at it as one aspect of investing. So let me just explain this circle, and then I'll go into the detail of how we do the responsible investing. Firstly, attractive returns. If you're a fund manager, your prerequisite, the reason people give you money is essentially because they want to make a return. So for us, attractive returns comes first, and we've always believed since the beginning of the firm that to deliver attractive returns, you have to incorporate sustainability into your investment process. Sustainability is described by us as ESG, environmental, social, and governance analysis of companies. And I'll explain why that is important in a second. So we believe by incorporating ESG into our investment process, we can deliver those long-term returns that Isaac mentioned earlier in his presentation. Now, because we've implemented ESG in the investment process, our portfolios are what we would call responsible investments. Our clients, yourselves, in various parts of the world, can be proud to own these companies, because these companies are considering long-term sustainable growth within their economies. And remember, we're often investing in emerging markets, India, Africa, Latin America, places like that, where we want these companies to be a part of the economic development of those countries as much as, for the profits they can deliver us. So as a consequence, our portfolios are responsible investments. And we also believe that that's not where our commitment just stops, because there's one thing telling companies how to behave. How do we behave ourselves as fund managers? Because ultimately, the way we allocate our capital shapes society. And so 10% of all the revenues that Alquity makes, that's not the returns our clients make, because that's completely separate and that's for our clients to retain. But from the fees we charge for running the funds, we donate 10% to what we would call transforming lives projects where we invest. So these are projects in the countries where our investments operate, helping some of the poorest people onto the economic ladder. Our goal is to create a fair and equitable society. So what we want to do is reduce inequality, particularly in the emerging and developing world. And so by helping people onto the economic ladder, they contribute to the economic environment, creating a more sustainable economy in which our funds then invest, and as a consequence, help deliver those long-term attractive returns. So this is the Alquity Virtuous Circle, and something that sits at the core of what we do as a firm across the business. Now, let me just start by talking a little about that first piece. I mentioned the attractive returns and integrating ESG into the investment process. We do something called forward-looking ESG integration, and a long term, but let me explain it in a simple manner. What is different with ESG integration to what fund managers were doing before? And the way I like to think about ESG is I like to think about ESG as if a fund manager was an artist, it'd be the paint palette of an artist. It's what does a paint palette bring to an artist is what ESG brings to a fund manager. And this picture kind of probably explains it in a more visual way. Prior to ESG, when fund managers are looking at an organization, they're trying to build a picture of what that organization or that business looks like. Now, if you don't have any paint, the only option you've got is to sketch it, whether that's through pencil and or chalk or whatever instrument you have. Now, that will give you a good structure and that will give you an idea of what the picture looks like. But if you really want to understand what's going on, if you really want that depth, the real texture, the real understanding of what you're looking at from a business, ESG brings you that. And so the difference between a fund manager using ESG and not using ESG is literally this: the ability to create a picture, a deeper and more meaningful picture of your organization, or the organization you're looking to invest in. And for us, we see ESG as almost a proxy, a representation of the quality of the management team that we're investing in. Because if a management team cares about the environment they're operating in, they are unlikely to pollute, or they're unlikely to create emissions that might actually stop them being allowed to operate, because the government or the regulatory authorities may come in and say, I'm sorry, I'm not prepared to allow you to continue to pollute as you're doing. If you're not looking after your employees, guess what? Those employees will go elsewhere. If you're not looking after your community that you operate within, your communities will challenge you and not buy your products. And ultimately, if you're not well governed as an organization, there will be issues such as corruption or scandals that will follow an organization in its journey. So ESG is a really good representation of the quality of management and a good way of building a picture of an organization. So how do we do that at Alquity, and how does that help us deliver returns as well as meet those sustainable objectives that we all have, whether it's the United Nations Sustainable Development Goals or any personal values and targets we have as individuals? This is a quick overview of the Alquity investment process. I won't dwell on it too long, but essentially it consists of three parts, as most investment processes do, so there's nothing radical here. Firstly, you have to identify the companies you're interested in, the filter phase, and essentially also the companies you don't want to actually even consider. And this is where often your values and your judgments come in. Once you've identified those companies that you actually are interested in, you've got to dig deeper. You have to look at whether that company's stock is valued attractively or not. And are you going to make returns out of it? So that second phase is about the valuation. And then once you've got that valuation, you construct a portfolio. Now, your responsibility doesn't just stop there, because once you own a company, you need to work with that company. It may be on improving its in ESG, maybe on the fact as that company goes through its journey, things may happen that you weren't expecting, and you need to revisit your investment case. So 3 steps. Let me talk about each step and how we integrate ESG into each one. If we take the step 1, you'll see at the second from bottom filter is ESG red flags. This is our first kind of gateway, shall we say, for companies that we're investing in. So for us as an organization, we have our values say that there are certain sectors that we believe do not add value to society or actually help with the goals and the objectives of whether it's climate change or the UN Sustainable Development Goals. So we exclude a range of sectors. So those are listed there on the left. Now, in addition to those sectors, sector exclusions, we also believe that there may be companies in sectors you would normally, consider as investable, but their behavior or their standards are below what we would expect from a company that is a company we would want to invest in. So if you take on the right-hand side, the first point under environmental. So we say no disclosure of water usage or conservation levels for significant users. So if you're, for example, a beverage company, you make drinks, you make soft drinks or whatever it may be, we know you are a large user of water as a consequence of that. If you're not disclosing that, if you're not actually sharing people how you're using that water and whether you're recycling, because we're clearly aware water scarcity is a growing and challenging issue for the planet, we won't invest in you, because this is a material issue to your business. Because if your water supply is reduced or is affected, that's going to affect the future profitability and future operations of your business. So it's not just a values-driven approach, it's actually going to affect the long-term value and profits from that organization. Likewise, if you're a high-risk industry, and I'll explain that in a second, and you're not producing emissions data, you're not producing data on your greenhouse gases, etc., we won't want to invest, because clearly there may be a point in time where government regulations or consumers will say, I'm not prepared to invest in or buy your products because of the emissions they produce. So Along the right-hand side, we have a series of red flags that combine our exclusions, but with other standards that we expect from organizations that we invest in. So that's the first step, the filter, making sure that our investable universe does not consist of companies that we just wouldn't want to be a part of. Now, once we've identified those companies we are prepared to consider further, we really dig deep. And this is where ESG investing and financial analysis kind of come together. For us, we're active investors. So that means our fund managers and portfolio teams go and visit companies. They go and talk to management. They go and visit operations. Less so over the last 12 months because of the pandemic, but increasingly, we're doing this over Zoom meetings or whatever. And so we're actively looking at companies. Now, when we're looking at companies, we split companies between high risk and low risk, primarily because how you operate as a high risk in a high risk industry, which includes things like mining, energy, heavy industry, things like cement. We've also included livestock farming in there because of the greenhouse gas emissions that it produces, aviation, shipping, things that produce large impacts, whether that's emissions, resource use, or waste production. When we're looking at those companies, we want them to achieve global best practice. We want them to be at the top of their industry because it matters. And how you run a cement company in Africa and how you run a cement company in the UK, you face similar challenges in terms of greenhouse gas emissions, in terms of water usage, in terms of employee health and safety. So we hold higher risk industries to a higher standard. And we rate companies A, B, and C. The reason we rate them across three different grades is because actually, when you're looking at investments, sometimes companies that are in emerging and frontier markets, they're developing, they're in early stages of their growth. They may actually move from a C to a B to an A over time. And that movement of as they improve their ESG behaviors often translates into returns because the rest of the industry start finding out about these companies and then actually invest, and they kind of affect their stock price positively. So for us, ESG is a great way of identifying winners earlier, as well as finding companies that are behaving in the right way. So first step, filter. Second step, understanding the deep ESG behavior of a company. And then, let me give you an example of how that enables us to find companies. Here is a company called Amrutanjan. It's a healthcare company based in India. It's around 125 years old as a brand. It's a very small company in terms of market cap. When we first saw this company, it was about $150 million of market cap, which is, in relation to the industry is relatively small. And what they produce is pain balms for fevers and colds, etc. A very well-known brand within the kind of lower consumer class in India, but a brand that was growing. They also started producing products that were competing with some of the big companies like Unilever and Procter and Gamble. They were producing, for women, and a big issue in India currently, and in many countries, in developing countries, is sanitary products, for affordable sanitary products for women. And so this company produced at a price point sanitary products that enabled access to sanitary products for women. As a consequence, they've been able to build their brand and grow their profits through this kind of focused product development. So not only do we have a great company with a great brand, with a great growth prospect, but we're also helping achieve some of the United Nations SDGs, for example, UN SDG 3, which is about good health and well-being. So this is a company that achieves those. Since we invested in that business, we've delivered a return of around 144% in terms of return, so close to 150% return over a 2-year period. So you can see how ESG, great companies, and returns all sit hand in hand. So that gives you an idea and a quick overview of how we invest in companies. But it's not just about investing in those companies, it's what you do once you own those companies. And not just what you do once you own them, but also kind of talking and engaging with companies to enable them to change. This is particularly important in emerging and frontier markets because as a developed market asset manager, we're used to large, organizations in the UK, US, and in major countries in Asia, understanding ESG and disclosing lots of information. Whilst many countries, most people have not heard of ESG. They don't understand that actually they should be disclosing how well they look after their employees or what they're doing in terms of managing their water usage. So often our engagement with companies is an education process to actually help them on that journey. A good example of that is an organization we worked with over several years, and we continue to invest with them. An organization called VMart. They're a retailer, a clothing retailer in kind of the secondary cities across northern India. And I've given you a couple of Indian examples, but I can give you plenty of other countries as well. And when we first met them, this is a retail shop, so they sell jeans, t-shirts, things like that, and it's positioned next to the market stalls. In India, something like 93% of retail is done informally. So that means it's done in stalls, in mom and pop shops, rather than through organized retail. And as the consumer class builds in India, we see this as a great trend to benefit from in terms of returns. VMart offers great shops, air-conditioned environments, good product pricing, the ability to pay with a credit card, etc. But when we first met them, we said to them, we're doing our ESG analysis. How do you ensure that the products you receive from your suppliers, and often they're getting supplies from places like Bangladesh, don't involve child labor, for example, or the health and safety conditions in the factories are satisfactory? And they said, well, we get the suppliers to tell us that. And we said, okay, that's great, you do that, but that's not really going to, that doesn't give you any kind of confirmation or any degree of assurance on that. And so we said, well, have you ever considered visiting them and conducting audits of your suppliers? And they said, oh, we haven't done that before, but it's a great idea. We'll start doing that. They started doing that. We visited them again a year or so later, and they proudly showed us that they'd been visiting some of the suppliers, and we said, fantastic. But do you tell them you're coming? And they were like, well, we do have to arrange our flight, and we do have to, tell them we're coming. I said, well, there's an issue there, because if there were any issues around child labor, etc., they'd just ensure that those issues were being dealt with on the day you visited, rather than you seeing actually the operations. So we actually put them in touch with IKEA, who have a sustainable sourcing, responsible sourcing policy in Asia, and we know IKEA pretty well. And so they actually talked to IKEA and kind of borrowed IKEA's mystery shopping and mystery audit approach, and actually implemented within their organization. It was only once they did that did we then say, okay, we believe you are now acceptable to us as a potential investment. And we invested in the stock in around the kind of late 2015, early 2016. And as a consequence, you've seen, from that chart on the left, the potential returns. But remember here what I said earlier about ESG being a measure of the quality of management. What we were able to learn through that process is that this management team were really committed to make those changes, really committed to do those things that were going to make a difference. And that helped us build our conviction and deliver those returns. So engagement is a key part of our process, and should be a key part of any kind of sustainable investing. And as you see, our engagement builds in all elements of sustainability, whether it's environmental. So we're really looking for companies to, disclose their emissions, their water usage, their waste, what plans they have for reducing their environmental impact over time. Do they have health and safety policies? Do they look after their staff? Do they have gender diversity policies, both at senior management and at board level? So we're really encouraging companies across environmental, social, and governance aspects. And governance is really important here. It's often missed because people focus on sustainability as an environmental thing or a social thing. Well, actually, the E and the S are driven by the G, because if you've got good governance and strong governance in an organization, it is more likely that they're going to be successful in terms of their environmental work or their social behaviors. The Volkswagen scandal, for example, is a classic situation where with poor governance led to poor environmental outcomes. And so governance is a key part of our assessment. And what we do is we do something called key progress indicators, where each of these measures under these three are tracked each year against all our portfolios. And what we are able to then do is report to our investors how that has actually changed over time. So this is just an example of how between 2020 and 2019, our companies improved or changed their behavior in terms of what they were revealing or disclosing. So if you look at the first measure there, greenhouse gas emissions, last year 71%, this year 82% of companies are reporting their greenhouse gas emissions. That's an improvement. That shows our engagement is moving things in the right direction. Just a couple there, you'll see things like waste, plans for reduction of environmental impact. Those were KPIs we introduced during the year. So in 2019, we weren't talking to them. So those are the first measures for those KPIs. But as you can see, this is something you are able to track and we are able to share with our clients on a regular basis. The advocacy we undertake with our companies can cover all sorts of issues, and engagement with companies is not a quick process. You may often find new funds come along and they say we're sustainable, and we engage with companies and they give you fantastic results after being only running the fund for a couple of weeks. The reality is engagement takes time. Companies take time to make changes. There's some examples here of companies we've worked with. Escorts, it's a tractor company in India. They'd never produced a sustainability report previously. They'd never produced one as an organization. Through some of the work we've had with them and done with them, they've produced their first sustainability report. It has two benefits to us. One, clearly because it's a good thing to do, but secondly, once they produce that report, investors who typically would not be interested all of a sudden actually start using that information and see Escorts as a potential investment opportunity. And so for us as existing holders, that's a great returns opportunity. Xstep in China, a sportswear manufacturer, getting them to show their greenhouse gas data in their ESG report. They'd never done it before. Through our engagement, we were able to encourage them to do that. So engagement is a constant process that takes time, but can deliver some fantastic results for our clients in terms of long-term returns. So I've explained how we make investments in terms of selecting companies, how we then work with those companies to ensure that over time, not only do they do those things that we want in terms of sustainability, but also help us deliver those returns for our funds. Then we turn that ESG lens on ourselves, the transforming lives aspect of our business. And so when we're working with organizations in terms of our donations, as a company, we've donated around $2.5 million, transformed around 60,000 lives in various emerging markets. And we do this in three ways. We want to increase and improve the economic situation. In many economies that we're working in, the growth of the economy is really rapid. And unfortunately, with rapid growth comes inequality. And we want to avoid that. We want more equitable environments. So we provide skill to the informal sector, people who would otherwise be excluded from the economic environment. We provide skill training, whether that's apprenticeships, whether that's on nursing training, teaching training, things like that, to enable them to get into good jobs. We also support entrepreneurs and small businesses to help them grow their businesses. A great way of giving people the opportunity for work is creating that work. And so we're often involved in community projects and training of small businesses to help them build and grow their footprint. And finally, actually providing the finance. So this is to support, particularly in developing economies, support women and minorities to actually be involved, because often they're excluded from finance, excluded from the economy because of where they come from or their gender. And microfinance is a great way of supporting that involvement. So Alquity does that through its Alquity Transforming Lives Foundations, a foundation, and helps us achieve those objectives. And here's a few examples of the types of organization we've worked with. In Asia, for example, in Vietnam, there's an organization called Reach, and they have a fantastic model where they take some of the most disadvantaged youth in Vietnam and give them skills. Maybe it's hairdressing, maybe it's waiter skills, maybe it's chefs, cooks, and they build small businesses. They even have a sushi business, and they deliver sushi to businesses that is actually built, produced by chefs they've trained. The marketing is done by people who are trained in marketing. The delivery drivers get jobs, and this provides people who would otherwise be excluded from the formal economy training, so they can actually then move on and get jobs in other organizations. So Reach in Vietnam, and in places like Brazil, we have Luta pela Paz, and their title is Fight for Peace. They actually use boxing as a vehicle through which to train people in the favelas about, they're building their confidence and giving them the opportunity to learn. So they come to have, learn how to box, but they'll also do a lesson in business or training or whatever alongside that. So they combine those two together. One example I'd like to share with you now, and just to show you how that connects in with our investment process, is the one in India, Fool. Now, Fool is a social enterprise we supported since 2019. Fool stands for flower. It's Hindi word for flower. And what the organization does is just stunning. I find this really, really amazing. In India, when people go to the temples, they take flowers on a daily basis. It's a part of the worship. The problem is, the day after, those flowers are discarded, and more often than not, they're thrown into the rivers, they're thrown into the streets or whatever, creating pollution. And in the rivers, because many of these flowers have pesticides, they pollute the rivers, affecting the biodiversity, blocking up drains, etc. A few years ago, one guy, Ankit, who's in the picture on the left, thought, well, what if I took those flowers from the temple and created something from them, built something? And so he set up an organization where he collects flowers from the temples from the day after, and he converts them into incense sticks. Those incense sticks are then sold back to the temple goers, who use them to part of worship. So you've got this fantastic recycling business going on. And then one of the things he did was the jobs of actually collecting the flowers and making the incense sticks. He employed people from the lower castes, women primarily, who would otherwise only get jobs, maybe cleaning toilets and things like that. So giving them a job they could be proud of, giving them an opportunity to be involved in something. And many of them feel they're doing, because of the religious aspect of collecting temple flowers, they actually believe they're doing something that's good from a values perspective as much as from achieving the kind of goals from a financial perspective. Now, that organization, we're going to help to grow from around 70 or 80 employees to 5,000. That's our goal. And this is a great way of showing how we can impact on the economy. At the same time, it was about late 2019, before the COVID pandemic, when our investment team were in India, they went to visit the Fool team. Not only did they learn how to make incense sticks, but it was a great opportunity for our investment team to talk to the employees and say, guys, you now have a job, you're looking you have money in your pocket. Where are you going to spend that? What kind of mobile phone are you going to buy? What products are you going to use? And it's through these kind of conversations, we learn about some of the new brands, learn about ideas that other fund managers don't learn about. And remember at the beginning, I mentioned Amrutanjan, that we delivered some returns. Well, this meeting, we'd already knew about the organization and had started investing, but this meeting confirmed to us that this was a brand and a company that we should be looking at increasing our positioning in. And as a consequence, we've be able to deliver better returns. So you can see how our philanthropic work also impacts on our investments. And so in summary, Alquity, sustainable investing is about having a holistic view. You can deliver returns through it, absolutely. You need to be able to share that information and work with companies through your engagement to enable those companies to improve over time. It's not a static picture. And finally, we donate and back through our own commitment and our own responsibility back into those environments, because what we believe in is the long-term sustainable growth of society and investments. So as clients and investors in our funds, you can rest assured that we are not just following a short-term fad. This is something we've got built within our business DNA. Okay, I think that kind of covers what I'd like to say today. I'll stop the presentation there and maybe hand over to Isaac or Andre.
Thanks, Suresh. I'll share my screen again. And yeah, I mean, hopefully that was revealing and interesting, because I think it does really show where and how sustainable investing and ESG investing can be so important, where the direction is heading, how it can be implemented, how Oreana is working with our investment partners like Alquity to push ahead with this, and the importance of getting it right and implementing it, integrating it within the process. I'm going to finish just very quickly before passing to Andre. Just to point out that aside from the white paper, aside from the work that Suresh has talked about, there are other ways that Oreana can help, and there are other ways that Andre and our team of advisors can help you with this journey. We have portfolio solutions. We have investments that embrace sustainability, that embrace ESG, and we work closely with our portfolio partners to build that out and to be aware of how it can help deliver better risk-adjusted returns for you, our investors. You can work with Andre and the team to understand our investment outlook. We provide a lot of material on a monthly and weekly basis to keep people up to date, and we do believe in letting people know what we think and how we're thinking about it. And earlier this year, we released our medium-term outlook, our annual report, which focused in on 5 key areas that we think will deliver returns over the medium term. And one of those was sustainability and ESG investing. So another area you can get some information from. And beyond that, of course, is Andre and the team's expertise and capability at helping you with strategic advice, portfolio advice, investment management advice in a whole range of topics. So I do encourage you to reach out to them and keep in touch if you want further information on any of this or anything else that we can help with. Just again, quickly, it's been great sharing the stage or the virtual stage with Suresh. Thank you very much for coming on board at such an early stage in London this morning, but really, really valuable information there, I think. And with that, I'll pass over to Andre for Q&A. And Andre, you're on mute.
Thanks for that. Isaac, thank you very much for that fascinating insight, if you like, and Suresh, even more so in terms of providing, real examples of how this actually works. One of the, I guess one of the, and there's a question here that comes through is, a lot of your examples, Suresh, focus more on the emerging markets, if you like. Now, which I guess begs the question in terms of this ESG lens or the importance of such a lens. Is it more an important focus for developed market companies, or I guess for more emerging markets? And Isaac, please chime in as well if you like.
Absolutely, great question. It's equally important whether it's in developed markets or emerging markets. There's no difference in importance. There's difference in implementation. In developed markets, we have much greater regulatory structures. We have much greater onus on companies to disclose. So the availability of data on ESG for companies is much more prevalent. You have large ratings agencies, you have large ESG agencies that are providing lots of detail on these large organizations in the West or in developed markets. Whereas in emerging markets, it's less prevalent. There's less information, there's less data. So as asset managers, you have to work harder in emerging markets to get that information. But the benefit is that information can be used to drive returns, because there isn't that mass availability of information. For us now, we've just launched a global equities fund, which invests in developed economies. And that approach, the approach we're taking there, is much more of a data mining approach to ESG, because it's no longer about finding information or data that other people don't have. It's about how you use that data on companies and how you manipulate and develop that data to give you your insights. Whereas in emerging markets, it's much more a case of going out there, talking to companies, revealing that information yourself, and helping them on that disclosure journey.
Right.
So I hope that
Thank you. Absolutely. Absolutely. We probably have a last question here, and it's probably a valid one as well. With all this focus, I guess, in having an ESG lens in corporate, in the governance of companies, etc., is there a risk in which it starts to then impede upon the focus of returns or investment returns? So is there a risk of giving up returns in place of, I guess, more of these ESG initiatives and focus?
You need to think about sustainable investing in a variety of ways. I mean, there is a whole space of sustainable investing, which is impact investing, and it's about where your priorities are. Impact investing, if your priority is the impact, then clearly for you, maybe the actual financial return takes a secondary position. For us, actually, we believe that ESG, as I've hopefully explained, actually drives better returns. But that also, as an investor, you should care about other returns as well, not just the financial return. You need to care about the kind of sustainable return. By that I mean, how is this contributing to the impact on the climate or water, or how is that portfolio doing in terms of gender diversity? So the portfolio's impact itself. And then thirdly, you should be caring about what is the direct influence that organization is having on society. So, for us, it's the transforming lives. It's what are we doing as an organization? So I think sustainable investing or impact investing can deliver as good a return, but it also delivers returns in other ways that people are increasingly thinking about beyond just financials.
Right. So there's this paradigm shift, right? So it's not just focusing on financial returns, but different types of returns that can, equally be beneficial for
Absolutely. Absolutely. And clearly, as I've said, there are impact investments that can deliver, pure impact. And as long as you go in with your eyes open and clear about what it is you want as an objective, as an investor, you can find investments that will achieve all of those things.
Yep. Sounds good. Thanks very much, Suresh, for that very clear insight, if you like, on those things. And again, thank you, Isaac in Tasmania, Suresh in London. Hopefully you get some time to rest before you start the day this morning. And for everyone else, thank you very much for your participation. I hope you get a lot of value from that. I guess personally, it's exciting that these type of for some people are quite out there concepts can actually be now part of the search for returns, really, and actually part of your investment portfolio. So please feel free to reach out to us here at Oreana if you'd like to discuss these concepts further, or if there's any investment or strategic advice assistance that you require from us. But for now, thank you very much. I hope everyone has a good weekend, and please keep in touch. Thank you.